Hello everyone and welcome back to our lecture video. For today's topic, we will be talking about liquidity ratio. So before we start, let's talk about the definition of liquidity. Liquidity is used in finance to describe how easily an asset can be converted to cash. So in other words, if you're going to take a look at your balance sheet, specifically in the assets section, so you will going to choose there which are the assets that can be easily converted into cash. Normally, liquid assets are the current assets, but not all current assets can be considered as liquid assets. A good example of which is a prepaid expense. Here in the Philippines, since we are using Philippine Accounting Standards 1 or PAS 1, so that is our accounting standards if we are classifying between the current assets and the non-current assets as well as the current liabilities and non-current liabilities. Liquidity ratios are indicators used in finance to measure the ability of the company to meet, pay, or settle short-term obligations. In other words, we will be focusing more on the relationship between the current assets and the current liabilities. There are four commonly used liquidity ratios: the current ratio, the quick asset test ratio, the cash ratio or cash flow ratio, and we have here the net working capital ratio. Let's first discuss the definition of the current ratio. Current ratio is used for us to know what is the level of relationship between the total current assets and the total current liabilities. This ratio is used to determine whether short-term assets are readily available to pay or settle short-term liabilities. Our formula is total current asset. Let's divide it by. Keep in mind that the classification between the current assets and the current liabilities can be determined according to the guidelines of PAS 1. Meaning to say, whatever will be the total in the financial accounting reporting under the current assets and the total current liabilities, that is also the total current assets and total current liabilities that we will be using. Let us talk about quick ratio. Quick ratio is a refinement of the current ratio, wherein instead of using the total current assets, what you will be using here are the more liquid assets. So it's the total liquid assets, what are considered to be liquid assets. So we have here cash and cash equivalents. We have marketable securities. And we have here our accounts receivable. Take note that in the total current assets, we are not using here the prepaid expenses because it's not expected for you to convert it to cash or to sell the asset then convert it to cash. But in quick ratio, remember, inventory is also part of the current assets. But in the quick asset ratio or quick ratio or acid test ratio, it is being excluded. So the total liquid assets divided by total current liabilities. The amount of current liabilities in the quick ratio is also the same total current liabilities in the current ratio. Now let's move forward to another type of liquidity ratio, which is the cash ratio. Cash ratio is used in finance to have an indication if there's an impending crisis or financial crisis situation. Because in this ratio, what you will be using only are the cash and your marketable securities. Then you will going to divide it to your total current liabilities. Once again, the total current liabilities in the cash ratio is the same with the current ratio and the quick ratio. By definition, the net working capital is the residual amount after you deduct the current assets to the current liabilities. Net working capital is somehow a little bit synonymous to the equity, but the equity is the residual of the total assets less total liabilities. Here, the net working capital is the residual of only the current portion of both the assets and the liabilities. Let's write it here. Net working capital is equal to your current assets less your current liabilities. Keep in mind that if we are coming from the current ratio going to the cash ratio, you are using the more liquid assets. But the level of the current liabilities will going to stay the same. That's the end of our lecture video. So I will be commenting the link for some question and answer related to the liquidity ratio. Thank you all for watching and I'll see you again next time.